Look, if you were asleep 6 hours ago, you missed it. You missed the moment when the silver market didn't just shift, it fractured. This wasn't a dip or a bounce, it was a rupture. While the West slept, the East hit $100 an ounce for real, physical silver. And the big outlets, CNBC, Bloomberg, are brushing it off as some one-off glitch, hoping you scroll past it and go back to your 401k dashboard like nothing's changed. But I've been glued to these terminals since 3 a.m., and I'm telling you now, what's flashing on your screen in London or Wall Street? It's not real. This isn't just a pricing blip. It's a total regional split. And it happened while most of the US was still in bed. A major shift just happened, the kind that only makes the news after it's too late to act on it. I'm not some content creator. I'm a private metals analyst. I've spent over a decade trading physical silver and tracking vault flows most retail folks never hear about. I made this channel with an AI face for one purpose: speed. Because I got tired of waiting 12 hours for cable news to report what my terminal shows in real time. And I got sick of watching all these AI YouTube clones push fake silver hype, while real investors, people like you, were out there needing facts, not fluff. So here's what's real. That $100 print in Shanghai, that's just the warning sign. The real danger is what's happening in Western vaults right now. Physical silver is draining out of COMEX and the LBMA faster than anyone was ready for. And the arbitrage gap, the price gap between East and West, just widened to $13.89. That's not a spread. That's a rupture. That's structural failure. Let me be precise about what I'm saying. This isn't silver moving because of a chart or some Fed speech. What's happening now is a price reset, not a pump, a reset. A major divergence is opening up between Eastern and Western exchanges. And that divergence is pulling real metal off the market. The paper side can mint contracts all day long, but they can't print silver bars. And here's the part that should wake you up. Gold has been in a 77-day steady climb, rising slow and steady. But as of a few hours ago, silver took over. It just beat gold by 4x overnight. 4 times. When silver starts running like that, you're not in a normal market anymore. You're in the vertical phase. The phase where moves are so fast, the media doesn't catch up until the chance is already gone. So here's my commitment. In this video, I'm walking you through how the Shanghai premium just shattered the COMEX illusion. I'll break down the math behind the gold-silver ratio, and I'll show you how I'm allocating my own portfolio for a $130 outcome. No hype, just hard data. The kind of data the big media players won't show you because it would reveal just how fragile the Western silver market has become. This isn't about short-term trades. This is about whether the West can even hang on to its physical supply. But before I lay out my personal plan, I want you to see what locked in at 3 a.m. Eastern. These are the numbers that matter. Let's look at the chart I pulled earlier. Gold spot price, $4,624.39, pushing against the upper band of that 77-day rise I just mentioned. Calm, solid, exactly what a normal gold market should look like. Silver spot price, $89.88. Up 2.34% while the world was sleeping. That's the NY and London number. That's what you'll find on Kitco or mainstream feeds. But here's the shocker. In Shanghai, for actual delivery, silver is quoted at $103.77. Yes, you heard right. In the West, you can buy silver under $90. In the East, you can't touch it for less than $103. That's a snapped market. The discount in the West is now $13.89 an ounce. Think about what that means. If you can buy physical silver in New York for $89 and move it to Shanghai where it fetches $103, you just made a $13 spread. Subtract shipping, insurance, and the pain of international shipping. And you're still pocketing $8 to $10 per ounce in pure arbitrage. That's free profit. And when free profit shows up, the sharpest capital is first to act. Now pause. I want you to look closely at the gold to silver ratio. Right now, it's hovering around 51.4. If you're not familiar with this metric, it tells you how many ounces of silver you need to exchange for 1 ounce of gold. Over the past 20 years, that number has typically swung between 50 and 80. When it spikes to 80 or 90, silver is undervalued. When it drops to 40 or below, silver is expensive. Today's reading, 51, is middle ground. But the direction? Straight down. The ratio is crumbling, fast. Here's the lead lag dynamic you need to understand. Gold climbed 0.6% overnight. Silver jumped 2.34%. That's a 4-to-1 outperformance. When silver begins outpacing gold at that speed, you're not in a calm market anymore. You've entered the parabolic phase of the cycle, the stage where regular investors open their apps and realize they're 3 weeks late. Meanwhile, those already positioned, they're just watching it unfold. But here's what's keeping me wired at 4 a.m. If this $13 arbitrage gap doesn't close before the NY market settles today, something's going to snap. COMEX is a fractional reserve system. It holds a limited stash of physical silver in its official vaults and sells contracts many times larger than that supply. The system holds, but only if most settle in cash. When there's $13 profit per ounce on the table, people stop settling. They demand delivery. They want real bars, and they're shipping those bars east. When that happens, cracks start forming in the entire structure. Let's break down this concept, arbitrage dislocation, because it's the engine driving everything now. If you don't get this, you won't grasp why the $100 price in Shanghai is seismic. Arbitrage is a classic financial move. Buy low in one place, sell high somewhere else, and pocket the spread. Buy apples for $2 in town A, sell them for $3 in town B, you net $1. But a dislocation is more serious. That's when the gap becomes so wide, real physical inventory starts draining from the cheaper market into the expensive one. At that point, it's not just price movement, it's actual metal crossing borders, crates of silver being loaded onto cargo planes and shipped across oceans. That's what's unfolding right now. Here's a mental image. Picture 2 gas stations across from each other. Station A is selling gas for $3 a gallon. Station B, $4.50. What happens? Everyone rushes to A. They fill up cars, tanks, cans, everything, and they do it until Station A runs dry. Then that station has a decision to make, shut down or raise its price to match B. No third choice. Right now, COMEX and the LBMA are Station A. They're offering silver at $89 while Asia is paying $103. And institutional players? They're in line, grabbing every ounce they can, flipping it east for that premium. This isn't theory, it's happening. I've seen the vault outflow sheets. Registered silver on COMEX has been leaking for weeks, and now it's accelerating. Here's where the trap tightens. The COMEX can print as many paper contracts as it wants. Futures contracts worth millions of ounces can be issued by lunchtime. But they can't print metal. They can't summon physical bars out of air. And once that arbitrage hits $13, people stop playing paper. They want silver. Real silver. Which brings us to the most dangerous math equation on the table today. Let's run the numbers. Let's start simple. Let's assume the gold to silver ratio stays flat around 51. Let's also say gold holds steady at $4,624. Divide that by 51 and you get silver's fair value, just over $90, which is basically where it sits in the West. That's your baseline. No drama, no shock scenario. But let's push it. Let's test this against the more aggressive forecasts from the analysts I trust. Rashad Hodge, among others, has projected a ratio collapse to 40, not 51, but 40. If that happens and gold remains at $4,624, then silver instantly jumps to $115.60. No gold rally required, just the ratio tightening gets us there. Now let's talk about the reset path. What if silver just adjusts to the current Shanghai price, $103.77? If that happens and gold doesn't move at all, the ratio drops to 44. We're already halfway there. The divide is closing, whether Western exchanges want it to or not, which brings us to the pressure point, $13.89. That's the spread currently crushing Western prices. Every hour that chasm stays open, more silver moves east. Every day COMEX refuses to let silver catch up to Asia, more of their metal vanishes. The drain is real, and they're feeling it. Here's what we know. Asia crossed $100. The US is lagging by over $13. Vaults in New York and London are losing stock. The gold to silver ratio is shrinking. The prices don't line up. And yet, turn on CNBC right now, and you'll hear that everything's fine. They'll call it a head fake, a trap. They'll trot out a Wall Street name to claim $90 silver is unsustainable. So let's address the critics. Let's take their best arguments. Because if I'm wrong, I want to know exactly where. Here's the other side of the argument. Skeptics say the Shanghai premium is just a local price flare-up, a short-term liquidity mismatch driven by Chinese New Year buying or some obscure policy shift at the Shanghai Gold Exchange. They argue that $90 silver will crush demand in tech and solar sectors, creating a surplus that will send prices crashing back into the 70s. That's the bearish thesis. Then there's the dollar angle. The DXY, the US dollar index, has been mostly flat, but if it surges, that could break gold's 77-day uptrend and drag silver down hard. Historically, a strong dollar weighs on commodities, and silver's no exception. These aren't fake concerns. I won't pretend they don't matter, but here's my response, and it's based on over a decade of watching this play out. Industrial demand doesn't just vanish overnight. Solar panel makers can't ditch silver next week. They've got contracts. They've got builds already in process. Their factories are using silver paste right now. They can't flip to some new material on a whim. The machine doesn't turn that fast. And more importantly, the shift in demand isn't a drop. It's a rerouting. The silver that would have gone to Western industries is now being pulled east, to buyers paying a $13 premium. This isn't a demand crisis. It's a price imbalance. Now let's kill the paper short narrative. I've heard it for years. Bullion banks will just hammer the futures market, short it into the ground, and stall the rally. Sure, they can try that. They can flood the market with contracts. But here's the flaw. In a physical arbitrage setup, a paper short is just a promise to deliver metal that may already be halfway to Shanghai. It's a naked risk. You're betting you'll have metal to settle that contract when the time comes. But if the vaults are emptying and the bars are already on the move, you can't deliver. That's how short squeezes happen. They can bully the chart. They can't stop the flow of real metal. And that flow, one way, eastbound. If the skeptics are off, and I believe they are, the only tool left is to change the rules. So, what happens next? Let me walk you through the sequence I expect in the days and weeks ahead based on both past precedent and current signals. Step 1. Institutional pushback. I expect COMEX to jack up margin requirements sharply. That's the go-to move when exchanges feel the squeeze or fear a delivery run. Raise the capital requirements, force out the little guys. Suddenly you need 50% more cash to hold your position. Retail traders get hit with margin calls. They fold, the price drops. Institutions breathe easier. Watch for it. If you see COMEX announce a 30-50% hike overnight, you'll know they're worried. You'll know delivery demand is rising, and they're trying to shake out the crowd before it cracks wide open. Step 2. Media silence. Expect data anomalies or revision delays from the Shanghai exchange. Suddenly, their numbers will become unverified or under review. Western media will shift attention solely to NY spot prices and stop mentioning the $13 spread. That's the cover-up. Don't buy it. I'm tracking several key signals on my dashboard. First is the $91 breakout. If New York pushes past $91 today, the catch-up has started. That's confirmation that the Western price is beginning to reflect the Shanghai premium. Once we clear 91, it's a quick sprint to 95, then 100, then possibly 110. Second marker, the gold to silver ratio falling to 48. We're currently at 51. If it slips under 50 and hits 48, that's a structural shift. That's when even the bears will have to admit something deeper is changing. And here's the setup I want you to watch closely. Look at gold's 77-day upward channel. It's clean, steady, predictable. But if gold breaks above the top of that band, clears 4,700, there's no resistance until the reset zones, 4,900 to 5,000. If gold lifts off, silver will launch. The ratio compresses toward 40, and that puts us on track for $130 silver in a matter of weeks. The trap is laid. The institutions see it. So does smart money. The only question left, will retail investors catch on before the door closes? That leads me to what I'm personally doing, how I'm handling this moment, what signals I'm watching, what triggers I'm tracking. Let me be clear, I'm not here to give you advice. I don't know your risk level, your situation, whether you own physical bars in a safe or you're trading futures or holding an ETF. I can't tell you what to do, but I can tell you what I'm doing with my capital, and you can decide if any of that fits your strategy. I'm watching two specific tripwires. First, trigger A. If silver crosses $91 during today's NY trading window, I take that as confirmation the Shanghai premium is finally being priced in. At that point, I'll be increasing my position in physically backed silver products, not futures, not synthetic funds, real metal-backed. That includes vault storage programs, That includes ETFs that actually hold bars. And if I can get a decent premium, physical coins and bullion. I'm staying away from paper contracts in this environment, period. I don't trust the exchanges to honor physical delivery if this whole thing breaks wide open. Trigger B. If the gold to silver ratio falls to 40, as projected by analysts I respect, I'll consider rebalancing. Let me explain. If silver gains so aggressively that the ratio hits 40, I'll rotate a portion of my silver profits back into gold to lock in that outperformance. Why? Because at that level, silver may be overextended compared to gold. The ratio could snap back to 45 or 50, and I don't want to ride that whiplash. I'd rather bank the gain, shift some into gold, and let gold carry the next wave. Now here's where I draw a hard line. If the exchanges suddenly hike margin requirements by more than 50%, I'm sitting still. No selling, no panic, no letting short-term chaos scare me out of a position I believe in. This part is crucial. Margin hikes are designed to trigger panic. They're meant to force over-leveraged traders to liquidate. But if you're holding physical silver, not futures, not margin plays, then margin hikes don't touch you. They only impact traders in the paper game. So if you see the headline, COMEX raises silver margins by 60%, don't flinch. That's not a sign of control. That's a red flag of desperation. And this is my unbreakable rule. I will not sell any of my physical silver as long as the Shanghai premium exists. Selling at $90 when the East is buying at $103 makes no sense. Why would I offload silver at a $13 discount to the real global price? The only time I'd consider selling is if the spread disappears, if both New York and Shanghai are trading at $103. At that point, the arbitrage is gone and I can evaluate a fair exit. But while the gap's still there, I'm holding tight. And here's what's been gnawing at me lately, something I keep circling back to every time I scan these charts. The window is narrowing. The choice is getting binary. You either hold real metal or you hold a digital promise. And in an arbitrage dislocation, those are not equal. Paper can be created at will. Paper can be reloaned. Paper can be settled in cash if the exchange decides not to fulfill delivery. But physical is physical. It lives in your vault, your safe, your hands. And no spreadsheet, no exchange rule, no sudden hike can make it vanish. So here's what I ask you to do. Don't take my word for any of this. Pull the numbers yourself. Look at the COMEX registered silver inventory over the past 6 months. Watch the bleed. Open up the daily reports from the Shanghai Gold Exchange. See the premiums they're posting for physical metal. Chart the gold to silver ratio and watch the momentum shift. All of it is public. You don't need Bloomberg access to see this. You just need to know where to look. And if you do the homework, if you go through the same data I've been following, then you have a decision to make. Are you going to prepare now, or are you going to wait for CNBC to give you permission? Because by the time they say silver's heating up, it'll be at $120. The gap will be gone, and so will the opportunity. That's how this plays out. The financial media doesn't exist to get you ahead of moves like this. They're there to keep you calm, to keep you parked in passive funds, to keep you from making decisions that might rock the boat. I'm not saying they're lying. I'm saying their motivations are not aligned with yours. My motive? Simple. I want to profit from this market. And I want other everyday investors, stackers, and physical holders to have a shot at doing the same. That's it. I don't manage money. I don't work for a hedge fund. I don't answer to clients or compliance teams. I'm just someone who's been watching silver for over a decade, who saw this pricing fracture coming, and decided to create a channel to put this info out in real time. And look, I get it. Some of you are unsure about the whole AI avatar thing. It feels robotic, cold, impersonal. But here's the truth. I can write, record, and post a script like this in under an hour. I can have it live before Wall Street opens. If I did this the old-fashioned way, camera setup, lighting, edits, render time, it would take 6 hours minimum. By then, the arbitrage would have shifted. The numbers would be stale. The moment would be gone. The AI delivery lets me move at the speed of the market. That's the only reason I use the avatar. It's just a tool. The analysis, that's me. The research, mine. The voice and views, all mine. The avatar is just how I get the message out faster. So if you're still here, if you've made it to this point in the video, you're exactly who this content was made for. You're the independent investor looking for real data, the one who understands markets aren't fair and wants every edge possible. You're the stacker who's held physical silver for years, asking when the price would finally match the reality. You're the trader who's been tracking gold's 77-day climb and thinking, something's different this time. You're my audience. You're why I built this. Here's what I want you to do today. Watch the New York Open. Pay attention to whether silver pushes through $91. If it does, come back and leave a comment. Tell me what you're seeing. Are premiums spiking at your coin dealer? Are storage programs selling out? Is your local market showing stress? I want to know what's happening on the ground, because the data I see on my screen is only half the story. The other half is what's happening out there in real-world transactions, in vault programs, in coin shops, in peer-to-peer trades. That's the part the institutions can't distort. And if we don't break $91, that's fine too. It just means the pressure continues to build. It means COMEX is doubling down, refusing to let price respond to demand, and bleeding physical inventory in hopes the Shanghai premium will fade on its own. And maybe it will. Maybe Chinese buyers step back. Maybe the spread collapses. Maybe this whole thesis falls apart. I won't deny that's possible. But I don't think it's probable. I believe the demand is real, the arbitrage is real, and the Western exchanges are in a corner. Now let's talk about gold, because this video was titled Watch Gold Closely for a reason. Gold is the base. Gold is the stabilizer. Gold is the $4,600 anchor that holds the silver trade together. If gold collapses, if it falls out of its 77-day uptrend, this whole structure breaks. Silver can't stay at $90 if gold is down at $4,200. The ratio fails. The momentum dies. The thesis unwinds. So I watch gold daily. The range matters. Right now, the top of the channel is around 4,680. The floor is about 4,540. As long as we stay inside that band, we're good. If gold breaks out above, silver goes vertical. If it breaks below, we step back and wait for the next setup. And here's what people misunderstand about gold. Gold doesn't move on simple supply and demand. It moves on fear. It moves on central banks. It moves on global tension. Right now, all three are flashing red. You've got debt concerns in the US, you've got central banks hoarding gold globally, and you've got geopolitical risk in the Middle East, Eastern Europe, and the South China Sea. That's rocket fuel for gold. But if any of that cools off, a surprise peace deal, a Fed pivot, a smooth debt ceiling resolution, gold could break down. And if gold breaks down, silver doesn't just wobble, it gets crushed. That's the risk. That's the chart I'm watching hardest right now. Not silver, gold. Because gold is the keystone. Now here's my view on positioning. If you bought physical silver as a long-term hedge, nothing's changed. Your thesis is still solid. You believe fiat is being devalued. You believe central banks are printing endlessly. You believe metals will hold real value over time. And that logic still holds, more than ever. So if you're in this long term, you hold. You don't sell just because silver hit $90. You don't take profits unless your core thesis breaks, and that doesn't happen until governments stop spending and central banks stop printing. Good luck waiting for that. If you bought silver as a tactical trade and you're sitting on 50% or 100% gains, then you've got a choice. If you think $90 is the top of a typical bull run, then sure, take profits. But if you think this is a reset, if you think this goes to $130, then selling now makes no sense. That would be walking out right before the climax. And for those of you watching this and thinking, I missed it, silver's already at $90, I'm too late. No, you're not. You're early to phase 2. Phase 1 was the quiet climb from $70 to $90. That was the accumulation stage, the period where smart money was buying while the media called metals dead. Now we're entering phase 2, the recognition phase. This is when markets start realizing the arbitrage can't be ignored. This is when the West starts catching up to the East. This phase moves quicker, it's more volatile, it's more profitable, and yes, more dangerous. If you're thinking about entering now, don't chase it. Wait for a pullback. A 5 to 7% dip is very possible if there's profit taking or another margin scare. If silver slides to $84 or $85, that's your entry. But if it skips the dip, if it rips past $91 and keeps going, then let it go. Don't FOMO in at $95. Wait for the next setup. There's always another setup. But whatever you do, don't buy paper unless you fully understand the delivery risk. The heart of this thesis is about physical silver. It's moving, and once it's gone, no contract can bring it back. Paper is a promise, and promises break when pressure rises. If you want exposure to silver, stick to physical-backed ETFs, use allocated storage services, or buy real bars and coins. Yes, you'll pay a premium. Yes, it's not as liquid as futures, but you'll sleep better knowing you actually own something tangible. Now let's address what no one wants to say out loud, but everyone is quietly thinking, what if the exchanges cheat? What if COMEX and the LBMA see this arbitrage gap growing, see registered inventory draining fast, and just change the rules? What if they halt delivery? What if they switch to cash settlement? What if they pull what they pulled in 1980 when the Hunt brothers had the silver market in a headlock? That's not paranoia, it's a historical reality, and chances are they'll do it again. They've done it before, and when institutions face existential risk, they don't play fair. The real question isn't if they'll change the rules. The question is, will it stop the outflow of metal? Here's my take. Changing the rules works when the pressure is speculative. If this were just hedge funds stacking leverage with no intention of taking delivery, then sure, raise the margins, tighten settlement windows, and you flush the rally out. The market resets, but this isn't that. This is arbitrage pressure. This is real metal, moving from west to east because there's $13 of profit baked into every ounce. COMEX can change the rules all it wants. It can't stop someone in Shanghai from paying more than someone in New York. That spread stays open until one of two things happens. The Western price adjusts higher, or the Western vaults run dry. So, yeah, rule changes might delay the outcome. They might scare out a few weak hands. You might see a sharp pullback, a scary headline, a sudden 7% drop, but that's just optics. It doesn't fix the core issue. Two global markets have diverged, and physical metal is flowing to close the gap. The only real solution? Let Western prices rise. That's why I'm not worried about COMEX rewriting the rules. I expect it. I'm ready for it, but I'm not afraid of it. Because at the end of the day, you can't rewrite physics. Metal is heavy. Shipping takes time. Vaults don't lie. The physical world doesn't respond to press releases. It responds to incentives. And right now, the incentive is clear. Drain the West. Fill the East. Let's bring it home. What if I'm right? What if the Shanghai premium holds? What if Western prices catch up? What if we do hit $130? Here's what that world looks like. 1. Mainstream attention. Once silver crosses $100 and stays there, it will enter public view. Right now, precious metals are a niche asset, ignored unless there's a panic. But when silver sits above triple digits, when it shows up on Bloomberg and CNBC daily, the masses will notice. The same people who never considered metals will start asking, should I own some? That's when FOMO begins. That's when your neighbors, your accountant, and your gym buddy suddenly care about silver. That's also usually when a top isn't far off. 2. Industrial scramble. If silver stays above $100 for more than a few weeks, industries that rely on it, solar, semiconductors, medical, will begin to panic. They'll try to lock down supply. They'll hoard. They'll rush to source alternatives, but substitutions don't happen overnight. In the short run, high prices lead to panic buying, not demand destruction, and panic buying pushes prices even higher. 3. Central bank diversification. We've seen record central bank gold buying over the last 2 years. If silver enters a reset phase, some sovereigns will start adding silver to the mix, not massively, maybe 5 to 10% of their metals allocation. But when central banks move, even small percentages are measured in billions, and silver is a small market. A few billion can move it a lot. So if we do hit $130, that may not be the top. That could just be the midpoint. If momentum builds, we could see $150, $175, maybe even $200 if things spiral. But let me be very clear. Parabolic moves always end. They always have. They always will. In 1980, silver crashed 90%. In 2011, it dropped 70%. This one will end too, and it won't be gentle. So if you're riding it up, have a plan. Know what you're willing to risk. Decide in advance what price you'll take profits. Decide what portion you're holding and what portion you're exiting. Don't freeze. Don't watch it go to $175 and convince yourself it's headed to $300, because that's how you end up holding the bag at $90, but with emotional scars. Have an exit strategy. Don't aim for the top. You won't catch it. Take some profits at $110. Take more at $130. Let the rest ride if you want. Just have a plan, any plan. Blind holding is not strategy, it's hope. Final thoughts. The data is the data. The The Shanghai premium is real. The arbitrage is real. The vault drawdown is real. The gold to silver ratio is collapsing in real time. Those are facts. What isn't a fact is what comes next. I can show you historical setups. I can walk you through the numbers. But I can't tell you the future. No one can. Markets are chaotic. Anything can happen. So use this information. Do your own research. Make your own choices. But whatever you do it with conviction. Don't straddle the fence. Don't half-step. Either you believe in the thesis and take action, or you don't and you sit it out. But don't try to live in the middle of a market that's moving this fast. Watch $91. Watch the ratio. Watch COMEX inventory. Watch gold's 77-day channel. Because if gold breaks, the structure collapses. But if gold holds, silver's heading to $130. That's not a guess. That's just math. The screen lies, the vaults don't. And the vaults are being emptied. That's it. That's the video. If you're still here, you're serious. Hit subscribe if you want these updates in real time. Tap the bell if you want them before New York opens. And drop a comment. Tell me what's happening in your market. Are premiums rising? Are coin dealers running dry? Let's track it together. See you in the next one. Stay sharp.